Good afternoon, everybody. Thank you for attending this webinar. I have Gary Sparks with me today, and he is the owner of a property company called GCS Wealth.
Correct.
Welcome, Gary.
Hi James, how are you?
I'm great, thank you.
Good.
So let's get into this, Gary, because we have a lot to cover today. So, Gary, I know that you've been investing yourself over many years, and now you sell properties. And so, can you tell me why it's important to have positively geared properties?
Well, I think capital growth is important. Everybody likes to see capital growth, but at the end of the day, you don't want to be putting your hand in your pocket all the time to pay the rates and bits and pieces that might come out. So, negatively gearing doesn't suit most people. They prefer to have their money growing in their account rather than going backwards. And so we concentrate on positively geared properties.
Okay, thank you. All right, so from what you've just told me, you're saying that maybe negatively geared properties kill your cash flow?
Well,
and it's difficult to expand your property portfolio?
Yeah. Negatively gearing, I think, works for people with a high income that are basically looking for a tax break, and they don't mind taking a loss in the process, week to week, year to year. Right? They're looking to be able to claim the difference back against their tax. But for most people on average wages, that's not such an issue. So positively geared properties works better for them.
So people who are on a middle income, does it work out negatively geared on most properties for them?
Well, not with the properties that we do.
Okay.
Basically, we concentrate on the positively geared properties.
Okay.
We don't want to put people in a position where they're having to put their hands in their pocket.
Okay.
And so we avoid that if at all possible.
Great. But, if you really take it, interest rates at the moment are so low that it's very difficult to not have a positively geared property. But interest rates will inevitably rise. And so where will that put your properties that you are marketing right now to your clients?
Well, we do look at the interest rate situation, and we talk to our finance people basically to ensure that there's enough of a buffer in there so that if interest rates do go up, then they can still cope with the repayments. But ultimately, if you're getting a high enough rent return on your property, then regardless of the cost of the property, if the rent return is commensurately at a high enough level,
yes,
then it's a cash flow positive property, and it isn't going to hurt you.
All right. Well, that's already a lot to digest, Gary. So what kind of properties do you sell?
Well, there's a range of different properties, and there's some really good concepts out at the moment, including NDIS, the disability housing,
okay,
which has a very good return, funded by the NDIS for 20 years. The NDIS contributes towards the income as well as the tenant pays the rent as well. The returns can be very high. There's always an upside and a downside. The downside can be it can be a little bit harder to get finance, and valuations may not come up to the dollar.
All right.
We have another concept which is pretty recent called seniors co-living, where we put several seniors in the one house, just a regular house, but each bedroom has its own bathroom.
Okay.
And so you can put, say, 3 seniors in there, generally ladies at this point, where they share the house, and because they're paying 3 separate rentals, one each,
yes,
then the combined return can be anywhere up to 9%, right, which is a very good return.
All right.
And then for more regular things, we do dual occupancy, we do duplexes, those sorts of things. We've got 2 tenants in the one property.
Right.
And so you can get a good rental return there as well.
All right. Well, again, that's a lot to absorb. So can we just deal with each property at a time? So tell us a little bit about the NDIS scheme.
This is a 20-year housing initiative by the federal government. It's a bipartisan thing, both governments support this, where they're encouraging investors to build houses for disabled people to live in that are designed for them. And there's several different categories of disabled people. Basically, we determine where the demand is for particular tenants in a particular area, and then we'll put together a house and land package to suit those tenants, so that they're ready to move in when the house is finished.
Okay.
The returns can be very high. They're indexed to inflation twice a year. That's basically locked in for 20 years.
All right.
So that is probably the best return sort of investment property that we can offer at the moment.
All right. So you say that the yields are high. Can you elaborate on that?
Depending on the level of disability of the participant, and you've got high physical support, you've got fully accessible, you've got improved livability. Depending on their level of disability and how many people are in a particular house, there's a scale of payments that the NDIS can make. So that the returns, effectively, if you've got 2 participants in one house plus a carer looking after them, you can get anywhere between 12 to 16% returns. After paying your management costs.
All right, that's after costs.
Yeah.
Does that include rates and things like that?
That includes rates as well. It doesn't include, obviously, loan costs and sort of paying off the house.
All right.
But just general costs.
Okay.
You can get really high returns of 10, 12, 14, and even 16% we've seen.
Wow.
But if you're talking 12 to 14%, you're probably
that's
in the
really
ballpark.
good.
Yeah.
That's really good. So, who manages the investment? A real estate agent or?
No. The SDA provider, that stands for Specialist Disability Accommodation. It's a company that we deal with. It's a national company. They deal with the SIL providers, which are in each particular suburb or region. That stands for Specialist Independent Living. They have the participants on their books. So the SDA provider basically manages sourcing the tenants. You would sign a 20-year head lease with them effectively to manage the property for the full 20 years.
Right.
They obviously get paid their management fee only if they've got tenants in the house.
Right.
It's a highly specialised field, but there's a bit of work for them to do. Generally, you're talking about 10% for the management fees.
All right.
Yeah.
And even with the 10%, there's still the 12 to 16% return?
The 12 to 16% is after the management fees are taken out.
Okay.
Yes.
Well, that's pretty good.
Yeah.
So you mentioned 20 years. Does it go that long?
The government has actually funded this for $700 million a year over 20 years. It's in legislation.
All right.
The Labor government brought it in. Obviously, the Liberal government has carried it on. I think it's the only policy that the governments are in total agreement with.
All
So
right.
nobody's going to play with this.
That's encouraging.
Yes. It is effectively locked in by legislation for 20 years, and that the payments are indexed to inflation twice a year.
So does that mean each one of these houses that you sell goes into a 20-year lease, or could it be less?
Well, it is a 20-year lease that you're signing up for. The leases themselves might be 5 or 10 years, the individual participant leases.
Ah, right, the people within the property.
Yeah, those leases are quite long in themselves.
Right.
And once the participants are in there, they're not going anywhere.
Of course.
They found where they want to be, and it's actually designed for them, so they're going to stay there.
Right.
Unless something happens.
Yes.
But you're signing effectively a management agreement for the sourcing of the tenants for 20 years.
That's pretty
And that
good.
can be a good thing for the investor because that just takes all of the stress out of it.
Absolutely. I would like that kind of return for 20 years,
Yes,
Gary.
yeah, well,
Where were you in my younger days?
well, unfortunately, this scheme only came out in 2019, so it's a very recent
2019.
thing.
Wow.
Yeah.
Wow. All right. So, all right. Where are these properties?
Well, you can imagine there are disabled people all over the country, in sort of regional and also metropolitan and city areas. We've been doing a number of them in sort of metropolitan areas, particularly in southeast Queensland at the moment. We're also looking at other states as well, and also regional areas such as Warwick and Mackay, and where there is demand for this sort of housing, but there's very little supply, and the returns can be even a little bit higher because the cost of land is actually a lot lower.
Yes.
And obviously the return on your investment is sort of commensurate with the value of the property and the amount of money that you're getting in.
I understand.
The NDIS payments from the government are pretty much the same all over the country, wherever you are. It doesn't make a difference.
All right.
Yeah.
All right. So does the tenant, the disabled person, do they pay any money for this, or is it just all free?
Oh no, it's not free. No,
Not free.
They are required to pay up to 25% of their income towards rent. Most
Alright.
of them are on a disability pension, you would imagine.
All right, okay.
And so that works out to $9,620 that they're paying per annum for their component.
Wow.
But the NDIS pays the rest. Now, if you've got a high physical support participant, then the NDIS might be paying up to say $40,000 to $45,000 a year, plus the $9,000. You know, you're talking a good $50,000 a year income. You have two of those in the one house. You've got $100,000, right? You take off your 10%. There's around $90,000.
That's very good.
That's in your pocket. That's where the 12 to 16% comes in.
Oh, right, okay.
Yeah.
So they pay this 25% from their disability pension, and they've got the rest to spend on themselves.
Yeah, it is capped. They can't spend more than 25%. They have to have their own income.
All right.
But the NDIS pays the bulk of it.
All right. Well, that's good. That's good. So, and price range, Gary, because you did mention that there was some valuation issues that you mentioned right in the beginning. So, what is the price range of these properties?
Yeah, the cost of the build is about 10 to 15% more than a regular build.
Why would that be?
Well, the bedrooms have got to be larger, the bathrooms are larger. There's
Oh.
extra the fixtures and fittings, basically. You know,
Yes.
all the light switches got to be different. There's a whole lot of different things that have to be done
Yes.
for it to be accredited with the NDIS.
All right.
So that
okay.
adds to the cost of the build.
Oh, I understand.
When the valuers go out to value them, they're generally only valuing them against the regular build house down the street in the
I
same suburb.
understand.
And so the valuations can come in lower than normal. So really this type of investment is a very good investment, but suitable for those investors who are relatively well resourced. They can afford to put a bit more money into the property, 25 to 30% for deposit and costs effectively
All
to
right.
buy it. And the houses really start from around 600,000 upwards.
All right.
Yeah.
Okay. All right. Well, that's fine. I mean, that's small change for people in Sydney and Melbourne, isn't it?
Well, that's exactly right. A number of the people we've been dealing with have even been buying these for cash because they've got the money, and that's fine. They don't need to borrow.
Right.
Banks will only lend up to say 70 or 75%.
Okay.
So you do have to put a bit more in than a regular property. So that's
Right.
the downside.
Okay.
But if you can do that, then the upside is extremely good.
Terrific. So of course every Australian that wants a property is talking about their capital growth. Will these properties still have capital growth?
They will have the same sort of capital growth as any other property. Interestingly, if we're talking in the regional areas, then obviously capital growth may be slower than some metropolitan
Right, I
areas.
understand.
Having said that, some regional areas are having a bit of a COVID boost of sort of people moving to lifestyle areas and working from home.
Yes.
So that situation may be alleviated.
Mm-hmm.
But as far as capital growth is concerned, let's say you wanted to sell your house in years to come and even convert it back to a regular house.
Yes.
The house has been designed for disabled people.
Mm-hmm.
We have a very high ageing population,
Yes.
basically, that might be downsizing into their own house,
Yes.
in a lifestyle area.
Mm-hmm.
If they can buy a house which has been designed, for disabled people, and as they become older and more infirm, they can basically grow into it.
Yes.
That will extend the time period before they may have to go into care, because they can live in their house for longer because it's designed,
All right.
for their lifestyle.
So
There's high demand for this sort of housing on the second-hand market.
okay. So just a thought came into my head. That's sorry for the interruption. But, so somebody who's got an elderly mother or father, or both parents still, and they don't want to go into a nursing home, they could live in one of these homes, and the elderly parents would be able to cope,
Yeah.
and the children will be able to cope with the parents, with the demands of aged parents.
Well, that's exactly right. They could buy one of these houses. They could live in the house. I mean, it's a 3-bedroom house that might have 3 bathrooms.
Oh, okay.
And the elderly parent or whoever might be in one of the bedrooms, which would have direct access to one of the bathrooms. So, everything's suitable for them, for their level of, disability or old age.
Okay.
But they could still live in the rest of the house quite comfortably and share the space, and they can look after their parent or their loved one who might happen to be mildly or severely disabled.
Right. I know that's probably why the government's spending so much money on this, because they're trying to keep the elderly within the homes.
And there's a lot of disabled people and elderly who are in very inappropriate accommodation. They're in group homes, they're in nursing homes, they're in all sorts of places where they shouldn't be because there's no place for them. So that's why the government's doing this, so they can try and place people in their own homes, so they can live with independence and with dignity, and even with their loved ones, and they're not a drain on sort of government accommodation. The government's still paying, but they're paying a lot less than they would if they were in a care home.
Okay.
Yeah.
All right. Okay, so there's no problem with reselling them. They've got the capital growth. They've got the great returns. I must say, these sound like a good investment, Gary.
They have been proving very popular. There's not that many of them around. We have to work a little harder to get the house in the right location, the right design, etc. But once we've done that, then they're being snapped up quite quickly.
Oh, great. All right. We'd like to hear some more about that later. So we'll switch to another type that you mentioned. I have a few questions about the co-living.
Yep.
So let's do that now.
Okay.